Yield farming is giving crypto investors the opportunity to use their tokens to not only make them more returns, but also help move the DeFi space forward as a whole, which is pretty awesome. And the one platform that is bringing this to the next level is Uniswap V3. Now, they're going at this through a specific tool called Concentrated Liquidity, which allows the yield farmer to make their tokens a heck of a lot more efficient so they can use less tokens and gain a higher return. Now, it's important to know that this does take an extra level of expertise to be able to maximize that efficiency. And a huge part of this comes down to choosing the appropriate range for your position. And I'm about to show you 3 different ways that you can determine a safe and profitable range for your position here. Now, the first things first, let's head over to Uniswap and let's take a look at the dashboard itself. So for this example, we're going to use the ETH USDC pool in the 0.05% fee tier. Now, I'm going to go into more about how you can actually determine this fee tier that is going to work best for you. And I've already spoken a bit about this in our newsletter. Feel free to jump down into the comments and subscribe to that there. But you can see here, once we've put in the actual pool that we want to enter, we now can get to this point here where we can set the price range. So we have the option of going full range, which spreads out our liquidity across the entire potential price points from 0 to infinity. But what I want to do is I want to actually choose a range so that it concentrates our liquidity and has more tokens per each price point so that we in return get more fees. Now, let's get into our first tool, which is TradingView. We can actually look at the price action and figure out from here what's going to fit our trading thesis. So here, for example, we are on the weekly chart. So the first example I'm going to go through is if we want to hold a position for a year. We were a long-term investor. We want to hold this position for a long time, and we want to make it as kind of safe and as low maintenance as possible. For this, I would do this exact same procedure on the weekly chart in an amount of time that is typically going to reflect the amount of time that I want to hold my position. And it's basically as easy as finding strong supports and resistance that will likely hold for the next year. Now, you can get as detailed or as specific as you want with this. It's again is going to change depending on your level of technical analysis experience. It's going to change depending on the amount of times you actually want to monitor your position. But I guess to start off with, what I want to do is I want to look back to the last year, which is around here, and establish the highs and the lows of the range. So there will be a pretty significant low. Here will be a pretty significant high that price was not able to break out of. So likely moving forward within the next couple of months, we will see that price action will continue to hover into this area for a good majority of the time. Now, we can make this more efficient or less efficient, which conversely will change the likelihood of price exiting this range. So if we did want to make this a bit more concentrated, we can go to that next high and we can go to the next low. With that, we will be able to return more fees, but the likelihood that it is going to exit this range in a predetermined time frame is going to be quite a bit higher. On the other hand, if we want to make it safer but diminish our fees, we can go even further and find the next lower level or the next high point, and this will decrease the fees that we get. But we're not going to have to look at this for a significant amount of time, as this is quite a significant spread, and the likelihood that price will stay in this range is quite a bit higher. Now, let's say this example was to highlight someone who's holding their position for about a year. Let's say we want to hold it for a week. We can go down even into the half hour or hour chart and do the exact same thing there. So here we go. We pulled up the ETH USDC chart. I'm gonna get rid of some of these lines and we'll zoom in here. And now we do the same sort of principle. Let's say we want to hold this for a week. Here is today's price action. This is Tuesday the 17th, and we go back about a week. So up to around this point here. And same idea. We mark out the low and we mark out the high of the range during this time. Now this would offer us a pretty realistic range of what will likely contain the price action. And again, as time goes by, we can just monitor this and adjust this as needed. Of course, we can adjust it, the efficiency level as well, narrowing that down where we will increase the returns, but also increase the risk that price will exit this range here. The next tool I want to show you guys is a tool called Builder Metrics made by Jake Call and his team. It's incredible. Just has so much more information besides simply price action. It will also allow you to calculate your position and see what other traders are doing, who's having success, who's not, and it's just full on awesome here. So for this example, we're still using the ETH USDC pool. Let's say for our position, we want to put in $1,000 and we want to hold it over 30 days. This one kind of automatically populates a range for you, but I want to make sure that this is really going to hammer it out of the park for me. So let's take a look. Let's scroll down here a little bit and we can see here the range that they automatically put in for us. But I want to mess around with this a little bit here. I want to lower the low point and also bring down the high point as well here. That's not even on our chart. So by doing this, we're bringing down the upper and lower end of the range. This is all going to be between the last couple of weeks here. And again, same principle as we did on TradingView, just mark out the low and the high of the trading range over this period of time. Now, if we scroll back up, we can see that through this position here of $1,000, the likely that we will, over the next month of holding this, we will gain 97 cents every single day. Let's take a look at what it would have been like if we used the entire range and we did not concentrate our liquidity. Same position, $1,000 ETH USDC pool, we would have only gotten 3 cents a day over the next 30 days. So this is a really cool tool here. It really allows you to take a look and really forecast what your position will do over the next little while. We can go down further and we can see this kind of gives us an idea of impermanent loss and how much amount of each token is going to shift as price goes up and down. But then at the bottom, this is the third tool that I want to show you. This is top positions in this pool. And this one's fantastic. This one actually gives you an idea of already established positions in this ETH USDC pool. It tells you what their strategy is, whether it's short-term or long-term, and it tells you how much money they've deposited as their actual position. And it also gives you an idea of how much they're making here on their returns here. So this one here, for example, they deposited 3.5K into the 0.05 fee tier for a short-term position. Let's take a look here. Daily, they will get $40, and yearly, without compounding, APR is simply the returns that we'll get if they just let the fees accumulate and did not compound it back into their position, which you can do on Uniswap. You just have to do it manually. They will get a 400% return on their initial deposit. Now, of course, this isn't guaranteed. This is going to depend on where price moves, if they're able to actually keep around the price point. But let's take a look at this. So what you can do is you can actually apply this to your position, and we can see what that looks like for us for however much time we want to hold this position. So let's apply it to our $1,000 position in the ETH USDC pool. This will return us $5.23 every 24 hours for the next 30 days. But let's take a look here at how narrow this range is. It is tight. We're going to have to keep a very close eye on this moving forward for the next 30 days, because the likelihood of price jumping out of that is pretty decently high. Also, impermanent loss is going to be quite a significant issue if price exits this range and we end up canceling our position. We could experience some loss there, as opposed to simply just buying and holding Ethereum. So that's it for this one. Thank you guys so much for watching us. There's links to Builder Metrics and TradingView below. Also, feel free to subscribe to our newsletter to check out the entire DeFi yield farming masterclass that we have there in collaboration with Jake Cal. And let's keep going.